Hello, friends, colleagues, and clients. This is Richard Siegel with ARQ Wealth Advisors, and today is Wednesday, February 23rd, and it's time for a brief market update. Well, as we know, there's been lots of turmoil and turbulence in the markets lately for several reasons. Probably the most prevalent in recent weeks has been the Russia-Ukraine confrontation and most likely invasion. On top of all that, we have the Fed doing an about-face with their monetary policy. And looks like they're going to start raising rates sooner than later and stop the bond buying program to normalize interest rates. So today we're going to go through three areas of focus. The first is 2022, a year of normalization. Number two, obviously the market pullback. And three, some market data. So first and foremost, normalization, we can talk about interest rates. So the Fed pegged rates at zero for the last couple of years due to COVID. That's kind of a doomsday rate policy. Well, we're no longer in a doomsday scenario. We have learned to live with this pandemic. GDP, economic growth has been strong, and corporate earnings have been strong. And in order to tamp down inflation, rates need to start moving higher. So that's what they've been telegraphing, 4 to 6, depending on who you listen to, interest rate hikes in 2022. And you can tell also that mortgage rates have moved up by over 1% in the last few months as well. GDP, the whipsaw looks like that's over. The tremendous 30% plus drop in 2020, and then the 30% plus gain in 2020 and 2021 is now kind of moving towards a normal GDP growth. Looks like this year, according to the conference board, probably somewhere in the 2.5% to 3% total GDP output for 2022. Inflation obviously has been a huge problem caused by two factors. One, supply chain issues, which are starting to get repaired. And two, excess liquidity in the economy, which the Fed will be addressing by pulling back the punch bowl. Currently, inflation is over 7%, and by year end, by many accounts, should be much lower in the 3 to 4% range. And then finally, for normalization, stock valuations. Stocks have been trading at very high valuations, some of the highest of all time. And now with the recent pullback, coupled with the acceleration in corporate earnings growth, valuations are pulling back to more reasonable levels. So this pullback is now officially a correction. A correction is defined as a market pullback of greater than 10%. From the all-time high just 6 weeks ago or so, the S&P 500 is now down 12.31%. The NASDAQ has caught the brunt of it, down 19.6% from its all-time high about 3 months ago. And here's some of the real carnage. The FANG stocks, Facebook down 48%. Apple has done okay, actually, down 12.5%. Amazon down 23%. Netflix down 47.5%. And Google down 16%. A few other special mention here. Microsoft down 19.8%. And Tesla down 38.6%. Hate to say I told you so, but these high growth, large cap tech stocks have been trading at astronomical valuations for a long time. We've been discussing this ad nauseum, and we've seen this movie before, and here we go. So what's been working? Well, this year to date, you can see large cap growth stocks are down 14.6%. Whereas large cap value stocks down 5.1%. Value, namely energy, financials, industrials, materials, etc. And then emerging markets has been the big surprise this year, only down 2.8%. Some data to consider here. The forward price to earnings ratio on the S&P 500 as of today is 18.5. It was just a couple of months ago, it was 22. So it's really pulled back to levels that are more typical, especially when interest rates are in the 2 to 3% range. 18 to 19 is about average. So we feel that the S&P valuation now is fairly valued. The equally weighted S&P, not cap weighted towards those big cap tech stocks, is trading at under 17 times, so more attractive. The VIX, the volatility or fear indicator, is at 31 today. And this chart here just kind of shows you, here we go, here we are. And looking back in January, it was just about 30 plus here. In December, around the same. And you can kind of look back here in the spring. So when we see the VIX in the 30s, when we see corporate earnings continuing to grow, PEs pulling back, this looks like a pretty good setup. I'm not saying we're at the bottom yet of this correction, but I would think that the most of the damage is done here, and these indicators kind of point to a better future. Not to say that war is good, because of course by no stretch is that the case. But over the last several decades, you can kind of see here the last 5 times the world saw a significant invasion. 6 months prior to the invasion, 2 months after would be these shaded areas. And you can see once the invasion actually happens, the stock market starts to go up. Here, Vietnam, the Gulf War, Afghanistan, and then we had a recession about a year later, 6 months later, but a big market move here. Iraq War, big market move here that lasted a long time. And then Crimean crisis, this was 2014. Again, you could see the market took off shortly after that. Finally, I'll note here, I mentioned this in the last video, that these corrections are pretty typical. It's not fun when you're in one, but it's necessary to have a pullback to kind of normalize the markets. So since 1974, that's almost 50 years ago, once a market correction bottom is reached, about 1 month later, the market is up on average 8%, and over the next year, 24%. So when you're in the middle of one of these corrections, it feels like it's never going to end, but it does. And in fact, volatility creates opportunity. We've been deploying capital in recent days for new money and then rebalancing portfolios as well. So with that, we'll wrap. Have a great evening. Be well, and we'll speak to you soon.